The questions I always get from clients is, what should I do, the traditional 401k or the Roth 401k? Today, what I want to do is help you get to a solution or an answer that's going to work best for you. I want to talk about building tax free wealth, the cost of building tax free wealth, and why it may be a good idea to do, and also why the opportunity to do so may be closing as we speak. Hello, my name is Maurice Wilson, host of the Wealth Equation podcast, where we help you build wealth. Now, a lot has been going on in the 401k space that people may not be aware of. But let's break down the history of the 401k. So what is a 401k? A 401k is really a line item in the US tax code that allows you to contribute money to an account and get a tax deduction for, and also for the money to grow tax free, with one caveat that when you pull the money out, the money will be taxable. They first emerged in 1978, but really got going in 1981 as small privately held companies began replacing their pension plans with the 401k. Pension plans are obligations that companies have to fund. It's on their books. And when given the opportunity to pass that obligation on to employees and make it their responsibility to put money away for retirement, well, you can imagine companies lined up to do so. Now, the 401k is popular because people hate taxes, right? So you start your job and they say, hey, you can contribute 6% of your paycheck and knock your taxes down by 6%. Oh, we'll also give you some money called a match to do so. Well, this has been very attractive. And so since 1981, the 401k has been the dominant way that people save for retirement and save money on taxes. But what if it's not the best way to save money on taxes? Think about it. The very nature of what you're doing with the 401k plan is you're going to put aside a little bit of money to then grow to a lot of money. Well, which is going to cost you more in taxes? The amount you put in or the amount you pull out, right? If I put in $10,000 and it goes to $100,000, taxes on 100,000 is a lot more than taxes on 10,000, correct? So in the euphoria and the rush to save money on taxes, people have been quietly creating tax time bombs that they're going to have to pay in their 60s, 70s, 80s, and beyond. Because one of the things that has to happen if this is going to be successful is that you never run out of money. So you're going to keep growing that money in retirement. And every dollar that that 401k makes is a taxable dollar, right? So, what if there's a way that we could stop building these tax time bombs, right? What if there's a way we could put money away, pay taxes today, and never pay taxes again, right? Never have to worry about the government coming to us when we're 75, 72, and saying, hey, you haven't paid taxes on this account. You now have to take out a required minimum distribution. What if there's a way to build tax free wealth? Well, there is. In 2006, the Roth 401k was introduced. Now, it's not as popular as a traditional 401k for one reason alone. You don't get a tax deduction when you put money in. And for the high earners in this country, they like reducing taxes on the front end because they never reconcile with the fact that, hey, if I make 200, 300, $400,000, I'm just simply going to pay more in taxes. A lot of my clients, a lot of my prospects can't come to grips with the fact that more money, more taxes, right? And so avoiding that by deferring taxes today to pay more taxes in the future is not really the way you want to go. So the Roth 401k allows you to pay taxes today and never pay taxes again. This has a lot of benefits. For one, the U.S. Maximum or highest tax bracket rate, 70%, was cut in half over the last 40 years. Given what we have to accomplish in this country, we've got to rebuild our electrical grid for sustainability. We've got to repay or pay Social Security. We've got to rebuild our infrastructure. we've got all these obligations that are coming online against the lowest revenue the US has ever taken in modern history. So at some point, we either cut back on all our services and or we have to raise our taxes, right? And I'm going to bet that raising taxes is going to be what we're going to do because politicians don't go to DC to not do projects, right? So how can you get yourself out of the blast zone, if you will, of a tax time bomb? For a lot of you, you've already saved 100, 200, 300, half a million or a million or more in these 401ks. But you may want to consider now that you've built a nice sizable nest egg and you deferred and deduct the taxes this long, you may want to consider doing a Roth 401k. The Roth 401k has a number of benefits. One, you pay taxes at historically the lowest rates ever today, right? And two, you don't pay taxes in the future. So let's say you put in $10,000 and you happen to buy a really good investment like Nvidia or Microsoft or Apple, Meta, any number of these AI focused companies, and you hit the jackpot and it grows to 100,000, 200,000, 300,000. Which do you want to pay taxes on? The $10,000 contribution or the $200,000, $300,000 in gains, right? It's kind of like buying your house. You buy a house and the government gives you a certain capital gains exclusion, right? So you buy a house for a half million, it doubles to $1 million. Well, if you're married, you don't pay any taxes when you sell the house. Well, with the Roth 401k, you don't pay any taxes, period, right? There's no capital gains exclusion because there's no capital gains tax. So the Roth 401k can be an attractive way to build tax free wealth. Now, I can hear a lot of you saying, well, how am I going to afford the taxes on the contributions, right? Because that's the deal. One of the benefits of the traditional 401k is, well, if I'm not paying taxes today, I can put more into the plan. If I'm paying taxes today, I've got to account for the taxes and pull it out of what I'm putting in. Let's give an example. Client A wants to put $10,000 into a regular 401k. Client B wants to put the same 10,000 into a regular 401k, but client B has to pay 20% in taxes. If he pays it out of the $10,000 contribution, then he's only going to be able to put 8,000 in, and that's going to put him behind the eight ball. There's really no easy way around that scenario other than pulling the money from other things you're spending money on. Well, it just so happens that the average American is spending between $7,000 to $12,000 a year eating out, right? It's unhealthy. It's loaded with salt. It's a waste of money, for lack of a better phrase. So why don't we redirect the money we're wasting eating out and put it towards building tax-free wealth? It's not that you're paying taxes, you're prepaying taxes for a tax-free future. It's kind of like these college savings plans that let you pay tuition at today's prices for a child who's not even born yet, right? So if you could pay 1990s tuition for 2018 college, right? That's a bargain. And that's what's going on with these Roth 401k plans is that you are prepaying taxes today for a tax-free future. Now, let's take this a step further. One of the common goals of high income earners, people who work with financial advisors, is the legacy that they leave behind. Any money in a traditional 401k that's not left to a spouse has to be liquidated within 10 years. Those are some new rules that the government put in place under something called the Secure 2.0 Act. It used to be you could leave it to a spouse, you could leave it to a non-spouse, and they would have their entire lifetime to pull the money out. So let's say you're 60, you live to 90, you leave $1 million to a non-spouse that's like 50 years old. They've got another 40 years to pull that money out. And what happens is that million starts to double, triple, and quadruple over time. And then he or she can leave it to another generation. And you've created generational wealth. Well, the government needs tax revenue. So what they did was they said, no, if you don't leave it to your wife or your husband or your partner, then we're going to make whoever gets that traditional 401k, that traditional IRA, we're going to make them pull the taxes out, liquidate that money in 10 years. Now, you all know once the money comes out of these accounts, once you sell the investments, it's less likely that that person is going to put the money back into the market. And so all of the legacy that you were looking to build is out the window in 120 months after your death. Now, with the Roth 401k, the government no longer has its hands in your pockets, right? You paid them already as you were building the account. So now when you leave money to a non-spouse, they get to hold on to it, right? And now that money begins to roll over and over and over, and it's tax free, right? Which is really a big game changer, right? If I know that you don't have to pull 20, 30, 40% of your money out to pay the government, well, that gives you a higher return, right? On your money. In fact, it works both ways. You don't even have to make that money grow as much because you don't have to account for taxes coming out. And one thing I know about retirees, they hate taxes. Everybody hates taxes, but retirees really hate taxes. If you're enjoying this content, I welcome you to visit us at the Wealth Equation podcast on YouTube. We also are on what is it? We're on Apple Podcasts. We're on Spotify. Please check us out if you're enjoying this content. So let's get back to it. What I want to talk about today is the fact that most people are building tax time bombs in their traditional 401k. Now, if you've already done it, don't worry about it. What's done is done. But why don't you change what you're doing going forward by building tax free wealth? And the way to do that is in a Roth 401k. It works just like a Roth traditional 401k. You have the same contribution limits, but the big difference is you pay taxes today and don't pay taxes in the future. It gives you more control over your money. You don't have to do these required minimum distributions that the government wants you to have. And something I want to talk about now is I'm pretty certain they're going to start taking these Roth 401ks off the table in the near future. So I don't have a date. I don't have anything to back this up. But at some point, the government has got to start making changes in how these plans work to get their tax money back. So the canary in the coal mine to me is the change that they made with the traditional 401k, in that any money you leave from that account to a non spouse now has to be liquidated in 10 years versus before your beneficiary who wasn't a spouse had their entire lifetime to pull money out of that account, and then they could leave money to another person who then had their entire lifetime. It's what we call a stretch IRA. Well, the government took all that off the table with little fanfare, and we know how dysfunctional the government has been. What are the odds that both sides of the aisle agreed to some legislation that took something that was basically a low tax wealth building experience? They took it off the table for every American. That type of bipartisanship only happens when both parties know we've got to increase tax revenue. And so that's what they did. And then they disguised it in something called the Secure 2.0 Act, right? Something that sounds benign, but really isn't. Now, what they also did was they did go back and expand what could be done with the Roth accounts, the Roth 401k and the Roth IRA. They even put these accounts in for your kids' college savings plans, and they also put them in uh, well, they did that, the college savings plans, and I think they did something with long-term care plans. So, so they have been taking steps to get more money out of these traditional 401ks and expanding access to the Roth 401ks. But I believe that expansion is very temporary, just to get a certain generation into these accounts before they slam the door. Now, if you're a Gen Xer or a Gen Z or I think Alpha or a Millennial, you know the deck has kind of been stacked against you from day one. So what I would suspect is, and maybe I'll back out the Gen Xer. I'm a Gen Xer, but it could be my generation as well. I suspect when my generation gets to a certain point, and the ones preceding me get to a certain age where they're no longer putting money in these plans, they're going to take the Roth accounts off the table with a nice word. It sounds really benign called sunset. They're going to sunset the Roth accounts, cite some reasons about participation being very low, and then they're going to move on. So it behooves you, if you're trying to build tax free wealth, if you're trying to get out of these tax time bombs that we're in, to start taking advantage of these accounts now. You pay taxes today on your contributions. Now, where do you get the tax revenue from, right? You get it from that money you're wasting dining out. You get it from the money that you're wasting with all of these subscriptions. You get it from the money that we're wasting on all these new cell phones that we don't need. You get it from the money from all this traveling that people do all of a sudden, right? Because you're not delaying gratification, you're guaranteeing a tax free wealth nest egg that you can benefit from well into retirement, right? And who doesn't want that, right? If I can take a million, $2 million and have it be tax free in retirement, well, that's 30 to 40% more that my money's going to work for me because I don't have to account for taxes, right? I mean, so everybody's gotten a paycheck before, right? There's the top of the paycheck and the bottom of the paycheck. If I can zero out what's in between, then guess what? I've given myself a pay raise, right? So you're prepaying taxes to have more wealth later in life that's tax free and less control from the government. Um, my name is Maurice Wilson. If you've been enjoying this content, please check us out on podcast, The Wealth Equation. Also check out us out on YouTube, The Wealth Equation Podcast. Please sign up. We bring shows like this to you. I'm striving to do it on a weekly basis. I do have a business. It's Wilson Wealth, and we do actual financial planning and investment management. So I do encourage you to check us out on wilsonwealth.com if you're looking for a way to implement some of what we talked about today into your financial picture. If I could leave you with one thought, it's this. There are two things in life that are certain: death and taxes. But I would add that taxes going up in the future is the third certainty. Don't let yourself get caught up in an uncertain future where taxes are going up, and the wealth that you've accumulated is being reduced by more than you expected. Take steps today to build tax free wealth so that you can enjoy your future. Thank you for joining me today. My name is Maurice Wilson. This has been the Wealth Equation Podcast.